You have these few handful of influencers in Singapore. It's a small island, fairly homogeneous population, retail population. Um, they're all listening to the same people. So when someone comes out and says, I am quitting chocolate finance, here's why, 99% of the customers who saw that didn't watch the video. All they did is they opened the app and then they hit withdrawal.
Hello, everyone, and welcome back to the 60/40 podcast, the only podcast that deep dives Asia's business and tech headlines from the leaders actually driving the change. I'm joined by my two co-hosts, Prashant, the serial founder, and Peter Bithos, Singapore's busiest executive and our poet in residence, who's not wearing a tux this time. Today, we also have a special guest, Alexei Mironenko, resident fintech expert and wealth advisor. So thanks to everyone who listened to our first episode. To everyone who commented that they wanted to see us go deeper on some of the topics, this one is for you. Today, we're going to be deep diving what happened with chocolate finance here in Singapore before we turn our attention to the latest in China's tech scene and Malaysia's AI push. Before we begin, I should also note that none of us are professional journalists or investment advisors. Well, technically, Alexei, but not in this sense. So all opinions expressed on this show are for informational and entertainment purposes only. All right, we're going to dive into chocolate. There's a lot to unravel here, so maybe I'll just do a quick summary of what's happened so we can set the groundwork, and then we'll kind of deep dive into the analysis. So it's definitely been a crazy few weeks for Chocolate Finance, which is a robo-advisory service that's based here in Singapore. So what happened is that Chocolate launched just last year in July 2024. Its founder is Walter Deoud. I don't know how to pronounce his last name. Okay, great, thanks. He's a founder.
Just say Walter. Everybody calls him Walter. So just say Walter.
I was just trying to give it whatever. Anyways, the founder and ex-CEO of Singlife, which was an insurtech company that was acquired by Aviva in an M&A. So Chocolate's basically a robo-advisory service. Customers deposit cash with them. Chocolate will invest it on your behalf. And the basic guarantee is that you get better interest rate than standard bank accounts. And so when they first launched, that was 4.2%. I think now it's 3.3%. Anyways, it's been super successful. I think in 7 months, they gained 60,000 customers and $1 billion in assets under management. But this latest saga kicked off in February. They launched a new promotion with HeyMax, which is a Singaporean travels rewards platform, where they were offering 2 miles per dollar spent on their chocolate debit card. It was basically super popular, which was great for them. But what happened is that people in Singapore basically started going to AXS machines and started loading up on spend and collecting the miles. And on March 4th, Chocolate had to ask AXS to stop accepting its debit card while it got things sorted. It didn't give its customers a lot of warning. People were upset that the change happened without any sort of heads up. On March 9th and 8th, two popular Singaporean finance influencers posted YouTube videos basically saying that they were going to withdraw all of their money out of Chocolate. This obviously caused a huge spike in withdrawals, specifically the instant withdrawal feature that Chocolate offered. On March 10th, Chocolate had to temporarily suspend its instant withdrawals, and then, withdrawals would then take 3 to 6 business days, which is typical of all banking institutions. But as of today, Chocolate has now said that 90% of withdrawal requests have been met. Okay, sorry. That was kind of a monologue, but there was a lot happening here. But it was a lot. We had to summarize.
You got to cram in 2 weeks worth in like 2 minutes, right?
Yeah. I should talk faster. Okay.
Dogs and cats living together. It's terrible.
The main thing is that we're not trying to recap what happened, right? But we're trying to explore some of the underpinning factors and analyze lessons learned, and what this means for the broader industry. So Prashant, let me kick it over to you first and foremost. Can you break down the product that Chocolate was offering?
Yeah.
What is it, and why was it so popular?
Yeah, so first of all, everyone loves chocolate, right? Except for a few of late. And I think, look, before we unpack the product itself, maybe we just talk a little bit about why such a product would need to exist, right? If you look around the world, most people think they're very financially savvy. They want to find people like Alexei. They want to have people invest their money and grow their money, right? That's a deep human desire. But at the same time, we're all quite lazy when it comes to being good about our investments, right? Which is why around the world, most people end up putting their money in a fixed deposit, which benefits the bank more than it benefits the average individual. Yet we all seek higher yield, right? We want our money to work harder. We want to live the life of the roaring 20s, as you've seen in many of the chocolate finance ads. We just want a better life. And so at the very core of it, that's what Chocolate Finance and some of these other companies around the world look to address. They just want to get you a better yield, right? And to get a better yield, typically you either, I mean, in a very base case, you either take credit risk or you take market risk or you take tenure risk, right? So you have to take some risk along the way. And most people don't even want to go through the effort of evaluating risk and figuring out if it's for them and how that matches up against the return. So along comes Chocolate Finance. So sticking to the theme of delectables, chocolate finance is a layer cake, if you may. You have a layer cake product, right? At the base layer, you have this very beautiful short-term institutional bonds wrapped from a discovery and execution standpoint, right? It could be short-term bonds, it could be money market, it could be treasuries, it could be other fixed income products, but they've taken the complexity out of you having to think much about where that money is going. So they're actually not a bank. They don't have a banking license. They're actually a capital markets license holder, which is an important distinction because banks have certain insurances like SDIC, capital markets don't, right? So they are basically packaging products in a way that can meet the customer's objective of high yield, yet they're absorbing some of the kind of the discovery and execution related challenges, right? So at the very base of it, they've just made that super simple. They do have what's called a discretionary portfolio mandate, it's like a DPM license. So basically, they can take your money, they can invest it for you. They don't have to come and ask you about it every time. So that's also going for them. So that's the very base layer, and that, frankly, a lot of people offer, right? If you go to like a Stashaway or a Saif, or you go to like an Endowus or any of these capital markets license holders, they'll offer you that product. Yet you have to do a little bit of the heavy lifting yourself, right? Where this product gets more interesting for me is as at the next layer, right? They come in and they say, well, look, we'll actually give you a bit of a guaranteed rate, right? So the guaranteed rate is them saying, we have line of sight as to how this is going to perform because they're effectively going to hold to maturity on these short-term bonds. So they're going to give you a rate, and that rate is better than your fixed deposit or what your bank gives you on your savings account, right? The third layer of this is actually where things get even more interesting because, look, not everyone wants to have their money locked up, right? So effectively what I said is, while they may not be taking any credit risk, and of course they're not taking a whole lot of market risk, you are taking tenure risk, right? Your money is effectively locked up for 7 days, 14 days, 30 days, whatever they are doing, the money is locked up. So to kind of mitigate that, what they do is they create this thing called a liquidity pool. Now, this liquidity pool is where all the intelligence of this company lies, in my opinion, right? Because effectively what they're saying is, of course, if they kept all the money liquid, nothing is invested, it's not growing, you don't get the yield. But if they keep too little and invest a lot of it, yes, everyone's making a lot of money, but when people come to withdraw, which is one of their key features, instant withdrawals is one of their key promises, key features, if everyone comes to withdraw, they simply don't have the money, right? So managing this liquidity pool, its size and volume is actually one of the most key parts of this product. So, and I'm sure they do things like, hey, what time of the year is it? What time of the month is it? Like we know, and then they know like what the demand on liquidity is going to be, and accordingly they are going to match the investment payout to the liquidity pool, right? Then comes this product, which is the card, right? Now it's starting to look a lot like what your average bank offers you, right? Because now you've got the high yields, you've got the liquidity, instant withdrawals, and then you've got this card. The card is, again, a genius play because let's say Peter wants to take out some of his money to pay for something. It's a lot easier if it's on the card because he only takes out exactly what he needs when he spends at a point of sale, right? He can now spend. He doesn't have to withdraw and then remit, none of that. He's just spending. It's like a Visa card, right? And the card's beautiful, works really well. And then the last layer are these points, right? Who wants a card that has no points? So now you've kind of like gone from a slightly short-term, medium-term, locked-up capital investment product all the way to something that's earning you miles on the spend, right? So this is the layer cake. Now, obviously there was a huge pent up demand for this. Obviously the banks don't offer this. Obviously customers want this. Otherwise you don't see such beautiful product market fit. So you got to give it to the team that they nailed product market fit. You went from 0 to 1 billion sing in like 5 months, right?
Yeah.
And so that's the product, and I'm sure we'll unpack all the other pieces. But I'd love to hear what the other gents on the around the table have to say. But this is the product.
Look, who wants to jump? I'm dying to jump in. Go ahead.
Come in, Peter.
Oh my gosh. So that was an incredible financial services breakdown of an incredibly complex product that is pretty simple. I get 2 points for every dollar spent. Actually, I'll come at it from the other angle. I've done a little bit of fintech in my day, but I'm more a B2C guy. Here's a pretty simple tale as old as time, right? Number one, as long as I can remember, and probably dating back to the Wright brothers, there were frequent flyer miles that people valued more than money. There are countless businesses, not just fintech businesses, countless businesses that have gotten their scheme wrong and gotten stung as a result. And I think Walter's an amazing entrepreneur. I think Chocolate's really interesting. They just didn't do their homework here. They did 2 miles for every dollar spent, allowing bill payments. Oh, look at that. Ta-da! Look, I have experience. I used to run a telco, mobile virtual telco called Virgin Mobile. We offered free flights for every postpaid plan. Went through the roof. What we ended up with, a lot of bad debt and a lot of iPhones walking out the door. People have an emotional attachment to travel and points, and always have, and they just got the calculation wrong. They just got it wrong. And this is nothing like surprising, because this happens to businesses all the time. So they just didn't do their homework, and no, it wasn't gamed. Like, it was the fair dinkum terms and conditions offer, and people just took advantage of it, and as they should. So the second is you just lose trust in any, call it a bank, call it whatever you will. Like, it's an old fashioned bank run. That's all it is. Like, wait, they won't give me my money back? I'm taking my money back. Right? So, and it's those two things, right? Banking is trust. They lost trust. And they got a frequent flyer scheme wrong. There's like 2 really old mistakes of a bank.
Peter,
I don't think we should call them if we call them a bank, we're going to trip up some wires. They're financial services. They're not a bank. They're not like a bank.
Robo-advisory service.
Of course.
And to Prashant's point earlier, Prashant, you mentioned, the banks don't do this, and there was a need for this type of product. There's a reason the banks don't do this.
Yes.
Instant liquidity is hard. There are virtually no instruments in the world that you can settle same day. It's an exception. So if you are promising people a return, as you say, you take some risk, that means you bought something. And to give money back, you need to sell something or have excess cash that you didn't invest and you actually do, in fact, keep at a bank instantly available, which, of course, dilutes your return. So by promising instant withdrawals, they misunderstood how much their client base understood about the limits of that. And I don't think the issue is that people started taking money out. I think the issue is that people expected, despite all the fine print, that they could take all of their money out.
Yeah. Where do you think that liquidity is coming from?
Well, it's pretty simple.
Go ahead, Peter.
It's like, I completely understand that Chocolate is not a bank. Everybody on this podcast completely understands that Chocolate is not. Probably everybody listening to this podcast completely understands that Chocolate is not a bank.
Well, now.
But I like pretty sophisticated. I rate our audience. I think they're pretty smart. But the average person, you get an account, looks like an account. You get a debit card, looks like a debit card, right? I get frequent flyer miles. Okay, there's a lot of fine print that says it's not a bank, but I'm going to treat it like a bank, So, and that's just what happened.
And
So,
But from the
the way
cons
banks, sorry, Mary, the way banks deal with this issue is both through regulation and their own internal processes. They keep X% of capital um, always liquid, right? So banks take our deposits, they make longer dated loans, sometimes for a couple of days, sometimes for a few years, and they spend an immense amount of time and have an immense amount of experience figuring out that they need to keep minimum 20% available at any point, or 30%, and around the holidays maybe more, right? And that is what dilutes the yield, and of course their desire for profit. So chocolate is no different. They kept some money in liquid cash available for withdrawals. They invested, and if you look at their website, they invested in funds that buy bonds. Now,
Yeah.
funds are a 20th century technology that take 3 to 5 days to settle. Um, you cannot, it's very, very difficult to sell them in 1 day or in 2 days. You can make the decision to sell it on Monday, and the cash arrives on Thursday. Um, so in between, it's the liquidity pool, which means your yield is lower on that because it's not in the funds, or it's Chocolate's own balance sheet because they've guaranteed it. And the problem with providing your own balance sheet is unless you start issuing debt or you have a lot of it, at some point you run out. Um,
yeah.
and I don't work in a fintech world. I work in individual wealth management. Every single client I say, yep, your money's liquid. We can have it to you in 3 to 4 days. I've never ever said I can have it to you in 1 day unless we agree that I will borrow it for 3 to 4 days until the stuff I'm selling
So
Phenomenal.
arrives.
So, couldn't you find a debt provider? Now, you have $1 billion of customer funds. Yes, you have customer
Yep.
funds, but you are a discretionary portfolio manager, which means you effectively, if the customer signs that right off to you, you can liquidate that portfolio as you see fit. But you have $1 billion. Could you not go get yourself a $750 million debt
Credit line.
line?
Yep.
Yeah, which you can instantly draw. You think they just missed that? They were just using equity balance sheet, but they just didn't plan for this, or I mean, can't be that much of an oversight, yeah?
Yeah, with Walter, I don't like to assume that anything was missed. I think he's an incredibly smart and capable individual. So yes, maybe it was missed, but also the other possibility is that credit lines are not free, right? When you borrow the money, you're going to pay 5-6% or whatever the terms are. But while it's unused, whoever you've got the credit line from has to keep that money ready in case you need it, and they
Yeah,
charge you. They might charge you not. They won't. Of course, they won't charge you the full amount. They'll charge you 0.25% for any unused balance of the credit line. So if you have a credit line for 750 million Sing on your 1 billion total investments, that means your yield, it just goes down by 0.25 on 3/4 of your total. And now all of a sudden, are you able to compete? Are you able to offer enough of a yield to keep people interested?
I'll
Um,
tell you what else. What else costs money? Frequent flyer points.
yes.
So the icing on the cake is 2 points for every dollar used, right? That this is I read. I didn't actually know about the product in detail. I was a Sing Life customer, but I didn't end up being a chocolate customer. As soon as I read it in hindsight, I was like, oh my god, 2 points for every dollar used. They chocolate or anybody else who offers a frequent flyer the incentive for using their product has to go to Haymax, and Haymax goes to the airlines and pay money for every single point. And when you're constructing a product like this, and actually Chocolate said as much, just they estimate somebody would use, 30, 40, $50 or whatever they assumed a week, and the 50 points, and every point could cost a fraction of a cent. And they just got that wrong because they allowed AXS machines. They could pay their school fees and pretty soon the car
Taxes.
payment and taxes and whatever else. I was like, oh, I could have made a lot of points there. And they just got it wrong. And then when they pulled it back, it freaked the customer base out because they really loved it. Boom, you get an old fashioned bank run, even though
Yeah.
it's not a bank. I don't know what to call it.
so
Financial instrument run.
so were they just playing it too close on all margins? Like if you go back to Prashant's like 5-layer cake or whatever it was, they're already taking risks that obviously a traditional bank doesn't take, and then on top of that they layered this pretty aggressive miles rewards plan, and then were they just like cutting it too close on every single aspect of this particular promo and deal?
No,
I think so.
I would challenge that assumption a little bit because I do think they're taking the same risks as a traditional bank takes. They reconstructed, and Prashant and I've talked about this in the past in other areas. They've rebuilt the idea of a bank, like all the functions of a bank, outside of a bank. Right? You've got the debit card, they've got the long dated investments, they've got the short deposit accounts that you can put money into. Um,
Right.
it looks and smells and feels like a bank, and it is in fact making the same types of investments. I mean, maybe the only thing they weren't doing is they weren't giving us mortgage loans, right, the way a DBS or an OCBC would. But they were making all the same short-term investments that the bank does. Now, the difference is the bank does it for themselves, right? They promise you a yield. They invest in those things off their own balance sheet, and the over-under is on them. And therefore, they have gigantic departments of risk professionals and gigantic rooms for MAS professionals to sit next to those risk professionals, making sure they're doing it right and they are more conservative than they should ever need to be.
Which is why they don't guarantee 4.2% interest rates.
That brings up a good point. When you guarantee something, right? My and I've not dealt with the MAS directly, but dealt with the regulators overseas. But when you guarantee something, you have to be very clear about what that guarantee is, who's guaranteeing it, and how you're going to make good on that guarantee. Now, I don't necessarily think you can make good on these guarantees just by playing it right on the market, right? So at some point, they're also taking on quote unquote balance sheet risk, right? They're taking on
For
risk
sure.
to their own equity. So if for some reason the Fed decides to jack up the interest rates, right, and the underlying bonds, are subpar, but yet there's all this liquidity pressure.
Withdrawals,
You
yeah.
only have two choices. You're now, and you're guaranteeing this rate. You're either going to wait, you're hoping no, there's no credit risk in the underlying instrument, which I don't think there is because these are very highly rated instruments. You're basically saying, I will step in and I'll guarantee you this rate. So I'm assuming Chocolate is the guarantor, which means it should be very clear to the customer that Chocolate's going to stand in and pay them the 3.6 and cover the principal. They say that.
Yeah. So, okay. Actually, Peter, I kind of want to go back to when you were running Virgin Mobile and you had the frequent flyer issue. Like, how did you actually unravel that, and what did you do with the customer in terms of like the communication, rebuilding the trust? Was there any issue, or did you just take the loss?
Yeah, so what we don't know, and I would be very interested, Prashant, so I'll tell you about that in a minute, but Prashanta said, they really achieved product market fit. I would be very interested to know how many customers and how much of their 1 billion funds came through this promotion alone, right? So it would be fascinating to know. Now, was it before this product and they built up the funds before, which shows some inherent product market fit before, or was it this particular issue? So, I said earlier that people value frequent flyer and travel emotionally more than the money value that it actually represents. And there are countless examples of that. So my first P&L experience, CEO of Virgin Mobile in Australia, we were an attacker. We had to put layer on layer on layer, very similar. So the icing on our layer was a free flight that we had bought through a very similar mechanism for every postpaid plan that you sign up for. And we advertised and we did a deal through points with, of course, Virgin Australia at the time. So it was a nice branded play. But they were an independent company and we had to pay for points just like anybody else. And we amortized it into the plan over a lifetime value of the economics, right? So we knew it was a cost of acquisition, and we knew what the lifetime value of a postpaid customer was. First month, worked like a treat. Oh my God, we doubled or tripled postpaid. Second month, we were so happy. Third month, wait a second, a whole bunch of people in the first month weren't paying. Fourth month, they still didn't pay. And what ended up happening is they took the flight, they took the phone, and they took the credit hit on their credit report because the value of the flight to them was more important than the credit hit on their credit report. Um, uh,
Perhaps took the
and
flight and left the country, and that was that.
yeah, exactly. They went to London. I don't know. They hang out with Richard Branson in upper class or something like that. So, on our nickel. We had to immediately we changed nothing else in the plan. Nothing else in the plan. The moment we took the frequent flyer miles away, acquisitions went back down again. So the emotional attraction of frequent flyer points / travel is materially good. People will find a way to use it, right? So they will find a way. And that's the one thing in Walters or Chocolate's retelling. I really don't like calling this gaming at all. They got it wrong. They made a fair offer. Customers took advantage of the offer. They just got it wrong. They should just own it that way.
And Peter,
So
you asked earlier how much of it came from this promotion, and my sense is, of that 1 billion, you know, 2/3 was there before the promotion started.
Absolutely.
This was a business that was growing extremely well, and they were
Yeah.
looking for ways to turbocharge its growth. So this begs an interesting question. Prashant, you alluded to this earlier. Did they simply leave too little in the liquidity pool based on their first 6 months experience, not adjusting for the fact that this new customer set didn't really care about chocolate finance. They just cared about the points. And the moment that disappeared, that would have been 200 million, whatever that new amount that entered in February, it left in March, but they were still operating on these are traditional savers who just want a slightly higher yield, and they won't ever actually touch the money.
Yeah.
I just took a look on their website, and somewhere in the FAQ there's a risk disclosure that says this top-up program does not guarantee capital returns. Chocolate reserves the right to pause or stop the program at any time due to market disruptions, overutilization, excessive withdrawals, exchange restrictions, or other force majeure events. I had to click 6 times to get to that, which I assume means no one did. And that is, again, that's not their fault. This is how disclosures work, right? It is a perception issue that I don't know how you avoid this. I've never ever promised instant withdrawals because I don't know how to do it.
No, but I think the MAS is very clear on fair disclosures guideline. That I'm very sure. Look, and also look, MAS, like, let's just take the regulatory angle on this for a second. Like a very competent regulator, a very strict regulator that sets a very high bar, especially for retail, right? Like if this
Yeah.
was a set of like professional investors, accredited investors, I could even see like MAS saying, okay, look, you guys know what you're doing, or gals know what you're doing, so go for it, right? When it comes to retail money, MAS is like double, triple, quadruple click. Now, two things could have happened. Like the MAS also is finding this to be a new model. It's in form, it's absolutely within the box, and it colors inside the lines. And in substance, it does something slightly different. Maybe they're perhaps understanding it. They're perhaps also going through the fair disclosures and seeing if all that was met, if the customer really understood, et cetera, et cetera. But coming back to your point, I actually don't think they got just the liquidity pool part wrong, right? I actually think this is a company that went from 0 to 1 billion, mind you, in 4 months, right? That's a very, very, very short period of time in a fintech world to kind of make course corrections, put guardrails, adjust, create like some kinds of frameworks within which you can operate. It's a very short amount of time. So grew too quickly, and too fast, right? The second part is, I think what got them here was also the reason what caused this issue. And that is these influencers, right? So you have these financial influencers, and I'm going to remind us of Silicon Valley Bank, right?
Yep.
You have these massively homogeneous pools of customers, right? They're all listening to the same audio track. They're all listening to, in the case of Silicon Valley Bank, the same Twitter handles, the same VCs. And in the case of Chocolate Finance customers, you have these few handful of influencers in Singapore. It's a small island, fairly homogenous population, retail population. They're all listening to the same people. So when someone comes out and says, I'm quitting chocolate finance, here's why, 99% of the customers who saw that didn't watch the video. All they did is they opened the app and then they hit withdrawal, right? And so no one can plan for that, right? Even the biggest, most capitalized with the right CRR banks in the world are not prepared for that. So if you have homogeneous populations that are listening to the same audio track, and that's how you acquired them, then you're always going to run this risk that the day you're held hostage to that particular fin influencer effectively, right? Because if the day they say, I'm out, everyone's thinking, what does he know that I don't? Or what does she know that I don't? And I'm out too, right? Because there's no cost to staying in. Or there's no benefit to staying in. There's a huge cost to staying in, right? So that's actually what Peter kept calling a bank run. That's what caused it. It wasn't anything else. It wasn't like a betrayal of trust, a misread on the situation. I just think it was too much of homogeneity in the population.
Yeah, I
And,
mean,
and to
that's
your
actually, yeah.
Go ahead, Mary.
I was gonna say that's why I laid out the timeline, because what's interesting is that this withdrawal didn't happen right after they shut off AXS. People weren't pissed, and they didn't really think that it wasn't a situation where they couldn't get their money back. It was literally like 5-6 days later when these fin influencers, which is still a ridiculous term in my opinion, anyways, went online and started posting these things. I was like, I'm withdrawing all my savings from chocolate. Here is why. And so yeah, so you can. I mean, I kind of agree with Prashant, which is that it was that urgency, that emotional feeling that they got when they saw these YouTube videos,
That's
as opposed to, yeah, exactly.
But
And
it's just a modern form of banking. I mean, that's as old as the banking system exists. That is in essence, this is just the modern
There's
form,
someone
which is,
out there crying wolf, basically.
yeah,
No,
I
I think there's
trust.
Not
I,
every.
I have. I trust that if I put my money there, I can take it out. And if I get scared about it, I'm going to go take it out. And then other people go, oh, well, if that person is taking it out, I'm going to take mine out.
yeah.
That is
Yeah.
trust. That is brand. That is banking. And I know this isn't a bank, but if it's a duck up above and I'm a simple person, right? And it looks like a duck and it quacks like a duck. And underneath there's a Rorschach machine. So it looks like a duck to me. So, and there's somebody I know says, oh, you should take your money out. I'm going to go, oh, maybe I should take my money out. Right. So that's banking. And that's the risk they took and they got it wrong. Right? So,
I think there's an interesting thing here. When all of this started to happen, I'm not sure the value of chocolate finance versus the banks was still there, because in the very beginning, when they were very small, they were offering that 4% and change Sing dollar yield, which was very hard to find and match in DBS, OCBC, UOB, etc. Right? Fast forward to today, as they grew, you can no longer find a few interesting investments that are safe and pay you a lot. Now you've got to find a lot of investments that are safe and pay you a lot. And guess what? If they existed, everybody would be doing it. So over the last 7 or 8 months, we saw the yields that they were able to guarantee come down. Partially that's the rates coming down all over the world. But all of a sudden, if I said to you today, you can get a 3% guaranteed yield, is that higher than the banks that are in Singapore? Not really for an introductory rate, right? Remember, this is only for the first 20,000. So all of a sudden, the value add of having your money in chocolate finance versus taking that 20K out and moving it to DBS as an introductory offer, your yield wasn't going to be hit at all. And of course, DBS is a much more established, much safer name. So it was, to some extent, and this, not everybody will appreciate this comparison, but outside of finance, you have people making up new brands all the time that are effectively the exact same thing as the existing stuff, but just better marketed, better branded, right? Like new sodas, new chips.
Old wine, new bottle.
Yeah.
with frequent flyer points.
So to some extent, the moment the yields went away, this thing was the same as everything else, but with better branding. And the moment you get one little crack in that branding from a finfluencer, never heard the term before, then why wouldn't you take your money and put it somewhere where you can get the same amount of yield without even a hint of a question mark. And by the
Yeah,
way,
but
Well,
at no point was money at risk, and no one has lost anything, right? All that happened is it went from you get your money same day to you get your money in 3 days. So we
yeah.
shouldn't lose sight of that. Um,
correct. Correct. And look, I actually don't think customers are that rational when it comes to money, right? This like when we go in, we're not that rational. When we come out, we're not that rational.
mm,
So no one actually said that. Actually, so this is where I disagree with you, Alexei. I don't think someone said, "Let me open up the DBS fixed deposit rates or savings rates and let me compare the two." They just said, "I read this headline. The headline
mm,
says there's something could be off, and this dude is getting off. I got in because of this dude, so I'm getting out
yeah, yeah.
because of this." That's it.
Yeah.
That's the extent of I think how much you process, and the act of making it so simple to
It's so
withdraw.
easy, right?
It's
It's too
easy.
easy. It's too
So
easy.
why wouldn't I just like there's no inertia? I just open the app, Face ID, click.
No, you should like it should be like a phone call with like an OTP, like double
Which is-
OTP, sync
which
pass
is what
verification.
I would do.
It's like
What's up to
it's
the
just like
bankster?
online betting.
Yeah.
Or online betting, right?
Right.
So we could have another episode on that, right?
Yeah.
So yeah.
Okay, let's wrap on this one really quickly, but I want to ask one final question, which is we've talked a lot about the ways that chocolate was both innovative, but then also taking additional risks above and beyond. So but if you had to isolate what you think was the most critical factor in terms of causing this whole saga, was it the instant withdrawal aspect? Was it the miles promotion? Was it the finfluencers? Like, why do you think, if you had to isolate the one thing or the number one contributing factor that created this entire episode, what would it be? Prashanth.
Yeah, so look, I'm going to stick to the fact that there was massive amounts of homogeneity in this population that was driven by like one or two people who basically brought them in. And those are the people who caused the panic, who basically caused the exit. Like Alexei said, the product is, from a risk standpoint, it held up, right? And I do want to add like a founder's view on this. Maybe we get to that after we go through everyone else. But yeah, I think it's 100% because of the homogeneity in the population.
The finfluencer and the
Influencer, the homogeneity, that's what brought SVB down. And that's a fairly...
And
well-run-
maybe Henry Golding. Those were some great ads that you ran.
Yeah, the roaring 20s.
All right.
Everyone wants it.
Alexei, in your opinion?
I think if you have one killer feature, which is same day liquidity, and you put a teeny tiny little hole in that one killer feature, you undermine the entire concept. And again, this is not about blame, this is not about right or wrong, it's just the moment there was a question around the main benefit of the product, there's no reason to keep money in the product.
Yeah. So they never should have gone out to promise that to begin with, that they weren't willing to see it.
But then they would have never gotten
100%
customers.
of the time.
But then they would have never gotten any customers. That's the right. So
They should
that's
have
the
just
issue.
charged 50 bips for instant withdrawal. If you want instant withdrawal turned on your account, 50
can't.
bips.
Yeah,
And that 50 bips
exactly.
is the cost of debt.
Yeah. All right, Peter?
I'm going to take a different angle here. It's kind of a typical startup angle. It was a great ride. They were growing really fast. They wanted to grow faster. That passion, culture, drive to grow even faster, they just made bad calls and they misunderstood the risk of what they were offering.
Yeah.
And that, whether it's an old-fashioned startup of a restaurant trying to grow too fast or some multi-layered layer cake with amazing icing on top. So it's that mistake happens time and time again. I don't want to call it greed, but it takes that aspect of it. They just got too aggressive and they got it wrong.
I was going to say, it's like, from a founder perspective, I think you would consider these things as edge cases. You're like, yeah, sure, there's a very small possibility this would happen. But the fact that it happened within like 1 year of them existing shows you that it's not that much of an edge case and that maybe the risk there was a little bit higher than they had originally anticipated. Sorry, Prashanth, you want to end on the fintech founder view and then we'll move on?
Look, we're all Monday morning quarterbacking here, right? Like, so it's very easy to be critical sitting here in our Tech in Asia
And I would
podcast.
also say that Walter is one of the most respected, I think, founders
Absolutely.
in Singapore. So like everyone is like, he's amazing.
Yeah. So we're definitely Monday morning quarterbacking here. It's very easy to be critical. We say, oh, but the risks, they're so obvious. Yeah, all that's great. But look, this can either, and actually now, whether we like it or not, everybody in Singapore knows of this company, right? Everybody knows it. So this plays out two ways, one of two ways. And I think one of the things I really appreciated about Walter and the team is that they've been very transparent. You see him on LinkedIn. You see a lot of his, investors on LinkedIn posting kind of supportive messages, which is great to see. I like the transparency. I love the fact that they're coming out and playing this on the front foot. Great, right? And everyone knows about chocolate now. You've actually witnessed, as all of us Singaporeans have witnessed, a product, a founder, a company at its worst, right? So it can only be better from here. So in the best case scenario, what you have is high yield, instant liquidity, a card that's beautiful, points that work, right? You have this combination which none of our traditional banks have been able to package or offer, right? And in the worst case scenario, you basically had yourself a set of institutional bonds that pay out in 3 to 6 days, right? So your money was never at risk, or our money was never at risk. The outcome isn't that bad. When it worked beautifully. And I think you've seen the founders and the company at their worst. So you don't have to second guess how this company kind of builds from here. So I think from a founder perspective, I have deep amounts of respect in terms of like what they've accomplished as a product, what they've brought to market, how they've challenged the status quo, how they've handled perhaps their first crisis, right? Perhaps their first big crisis. And so on that front, I'm actually very supportive of the company, the product. And like I said, I think we've seen the worst of it. So, and it's not that bad. So why not keep going?
That's a nice note to end on. Let's turn our attention over to China. Basically, China's tech scene is on fire. I feel like every day we're waking up to some crazy headline coming out of China. So the one that kicked this off was the Seven Titans. I don't know if you all saw this, but basically there's a new term floating around called the Seven Titans being used to describe China's 7 biggest tech companies, which include Alibaba, Tencent, BYD, JD.com, NetEase, SMIC, which is their semiconductor one, and Xiaomi. So what's newsworthy is that in 2025, the 7 Titans have gained about 40% market cap. And actually, this is from earlier this week. I actually think with the latest BYD news, it's even higher, which adds about 439 billion, whereas the Mag 7, the US equivalent, has lost around 10% market cap. And then in addition to that, then we also heard about Manus AI, which was, which is like generally lauded as the next one to DeepSeek. It's the first generally useful AI agent. And then just yesterday or 2 days ago, BYD also announced like a 5-minute charging, like new battery technology that offers 5-minute charging for your vehicles. So basically, the innovation and the headlines coming out of China are absolutely insane. And yeah. Peter, let me start with you this time. How do you read the markets? How do you read these headlines? Would this China tech rally last? What do you think?
Well, first of all, there is amazing innovation coming out of China, but that is not new, actually. China has been, you go all the way to the early days of Huawei. China has been a source of innovation for many, many years, and it will be. What I find interesting is I wonder how much of the tech rally is more about the politics of tech now being okay in China over the last year, where it was on the outer politically for many years, 4 or 5 years, it seems. So the combination of some of the things that you see coming out, plus all of a sudden, for whatever reason, no one knows other than Z that the Chinese tech is now back in favor again, or at least acceptable again. Those two things kind of sparked. I wonder how much of that is playing into rather than the fundamentals. So it's a question. I have no idea. But it is, the innovation is always striking coming out of China. It never surprises me, but it always impresses me.
Prashant, what about you? I mean, you're building an AI-driven fintech company. Would you ever build on a Chinese tech stack, or how are you seeing the decisions?
Yeah, so look, I think we're absolutely non-favoring of any technologies from any part of the world. We do use DeepSeek when it came out. I'm very excited to kind of get my hands on Manus AI. And look, I think we're non-discriminatory in that sense. I think if it's open source and we can kind of like get our hands around it, we can really get to use it. I think we will. And frankly, we as a company are not as focused around whether it was state funded or venture capital funded or what have you, right? Like we understand, there's a lot of government backing that goes into Chinese tech, and maybe not as, and a lot of VC backing that goes into American tech, but we're too early in this game to kind of make very deep ethical calls about like what we want to use and what we won't use. We're open to all of it, and we're using all of it at the moment, and it's really good. Like I think the rate of change is so amazing, and for me, again, personally, I feel Chinese competition is good, right? Chinese competition keeps the world healthy in some ways. Indian competition is good. American competition is good. The Chinese, like we're talking about the seven titans, they're still 1/10 of the Mag 7, right? There's
Yeah.
still a long way to go in terms of like valuations and how these companies are perceived and valued. And that also shows the American financial dominance that continues to be at play. But specifically, I'd love to talk a little bit about Manus AI. What they're trying to do is they're trying to take away all these intermediary steps that we take in terms of like, actions we perform to ultimately get to our objective. They're saying, hey, just state the objective. Let the agents figure out, let them collaborate, let them kind of work together and eventually produce the outcome, which is great, right? Which just frees up a ton of time. I want to go from Singapore to London, right? I don't want to necessarily, figure out which points to use or which travel site to use, what fare class. I just know that this is my calendar, these are my dates. Just book me my flight. Just send me the boarding pass. Check me in, right? Let's
Give me
go.
my 2 miles via Haymax and let's
Yeah, it
go.
messed me up, right? So look, I think if you do that, hopefully mankind will spend that freed up time onto other things that are more valuable. So we are moving very quickly towards what I think looks like AGI, right?
Yeah.
Artificial general intelligence. And I think in that sense, I'm super bullish that this is the next step. But by the way, just because Manus AI came out, now there's pressure on OpenAI and the other
Yeah.
guys to
Yeah.
then step up their game, and then I think then these guys will step up their game. So deep research first, Manus AI next. Like I think that's gonna put a lot of pressure on. Like we just saw that Facebook open source their Llama models. So look, I think it just puts a lot of pressure for forward movement, and also keeps everyone at check. So AI, just like the internet, should be open utility,
Yeah.
and with some governance at the local layers. So I'm actually quite excited about these
Yeah.
changes.
Yeah.
Yeah, I love your point on competition actually, because, you know, back a couple of years ago, it was unclear whether AI LLMs would just become another choke point like Google search or AWS and just become another tax on a business in the operations. Like I have no choice. Okay, I could go to Microsoft, I guess, but essentially, there's not a million cloud providers out there that you can easily scale up on.
Right.
There's not many other Googles, right? So every marketing department in the world has to pay Google. What's happening with the competition that Prashant mentioned is so good because it just means accessibility and low cost for business and options. And you can get powerful, powerful technology now, and there is real competition pushing down the cost. And so the chance that we get another choke point on business where you have to pay some big tech company huge chunks of your X department is less and less and less as time goes on. And that's a good thing for businesses around the world.
But
Yeah.
Peter, it's actually a questionable thing for the valuations of some of these companies in reverse. Think about
That's true. In reverse.
The
Yes.
ATM when it
Yes.
was first invented, and everybody thought, oh, the bank that built the ATM, amazing. The stock price went up. And then within months, every bank had an ATM. And then within a year, An ATM was core requirement and now a cost. If you didn't have it, you didn't have a bank. If you had it, you had no advantage. Um, I speak a lot to investors about the Magnificent Seven, and I keep reminding people, the Magnificent Seven are six of them paying one of them. One of them is booking revenue, the others are booking capex, not expenses. And to your point, the innovation is clearly so fast, it's coming from everywhere. Um, there are marginal differences between Perplexity AI, OpenAI, Llama, DeepSeek.
Yeah,
I don't
I
care
totally
which
agree.
one I'm going to use. It is a commodity. It is a utility. It's what you do with it. So to your point, it puts the power back into Prashant's business, into my business, where I can start to think about how we use it. But I'm paying the lowest cost provider of it that delivers a good enough
Yeah.
service. And these guys, there was a crazy comment that OpenAI is losing money on operating. So the issue isn't how much it costs to build these things. The issue is how much it costs to operate these things. They are going to be utilities. And Prashant mentioned Magnificent Seven is still, the valuation is still something like 10 times the Seven
Yeah.
Titans. The issue with fundamentals is at the Magnificent Seven side, not at the Seven Titans side. To get too finance geeky here, the average PE of the Magnificent Seven is in the high 20s. The average PE of the Seven Titans is in the teens.
Yeah.
They're
Yeah.
doing the
Yep.
same thing.
Yeah.
Yeah. And we talked about this, we were talking about this run up in China and market cap and the prices. Last week, I think with Raghav here, we were talking about how there was pullback in terms of like investments from foreign institutional investors in some of the emerging markets, and I think some of that money just found its way into China. So
It's
basically, a
it's all
pullback in
pouring back
India.
in, I think.
Yeah, it just got
China's
diverted.
gain is India's loss,
Yeah,
Yeah.
exactly. That's
unfortunately, in
kind
the
of
stock markets for the time being.
Yeah. Okay. One last topic. Sorry, we're really crunched on time. Malaysia's AI push. We're going a little bit closer to home for Singapore. So Malaysia's AI scene is obviously having a global moment. Last week, they announced a $250 million partnership with ARM Holdings in an attempt to upskill and upvalue their value chain, their chips chain, sorry. And in the same week, Tan Lim Bu, who's originally from Malaysia, is now a U.S. citizen, has also been announced to take over as the CEO at Intel. So is this it? I mean, Malaysia, I think, has been one of the main semiconductors when people talk about the promise of chips in Southeast Asia. Malaysia usually comes out on top, but then people say, oh, but it's really, it's really low value manufacturing over there. So is this an opportunity that they have been looking for? So Peter, again, back to you. You spent a lot of time in Malaysia. What do you think are the biggest risks to this ARM deal? And do you think it's going to revolutionize Malaysia's chips industry?
Oh, well, so I'm sitting in Kuala Lumpur right now, actually, ironically. First of all, the context you said about the background is both true, but that doesn't make it bad, right? So they're low value chips, but there are low value chips in everything. Here's my earbud case. There's chips in here, right? There's chips in the panel on the wall. There's chips everywhere, largely low value, right? So, and that's not going to change. Whether or not Malaysia can pull off pulling up a level, the broader trend of supply chain risk mitigation in multiple geographies for geopolitical reasons is an upside for Malaysia. It's just an upside. It's a massive upside for Vietnam that is already cashing in on it. But it's like whether this specific investment sparks, super high value
Is
chips
this
coming
it?
back or
Yeah.
whatever. So I don't know, but the broader trend, so far, Vietnam's been the absolute winner, India as well, but also Malaysia is positioned geographically next to Singapore. It has land, it has a manufacturing base, it knows how to make chips. We need more chips on the planet, unfortunately. And as people go, well, I just want to manage my risk geopolitically for these massive plants. Malaysia, I think, is in well positioned. So we'll see about this specific invention. But Malaysia's well positioned, but they do a good job sometimes at shooting themselves in the foot. So hopefully they don't do that this time.
All right. So on that point, who else in Southeast Asia has a fighting chance of developing a really serious chip industry. I think, Peter, you mentioned Vietnam. Is there anyone else that we would even consider on this list? Crickets.
I don't think it's gonna. So I'm gonna have a controversial statement. I don't think it's gonna be anybody in Southeast Asia.
Okay.
Unfortunately,
Oh, wow, there
including
you go.
Malaysia.
Oh, there you go.
Malaysia has energy costs going for it, very low energy
Yeah.
costs, right?
Yep.
But the semiconductor chip industry is concentrated in Taiwan and Korea, and to a lesser extent Japan. And now you have
the U.S.
Well, I was going to say, now you have China and the U.S. making it clear
Arizona.
that it needs to be there, right? You want to sell chips in China, you need to build them in China. You want to sell chips in America, you're going to need to build them in America, and maybe Canada. We'll see. There's not enough room for anybody else.
Yeah.
Because if
All
you're
right.
a Korean, Taiwanese, Japanese, or Dutch part of the chip supply chain, your two biggest markets are saying, come here or don't come at all.
Yeah.
So unfortunately for Southeast Asia, they will be squeezed out through geopolitics,
I mean, I think
not
it's-
through any fault of their own, I don't think.
Yeah. Well, some, but I think that's a different discussion.
Where you guys live there, you're allowed to say it. I'm not going to sit in Hong Kong and say bad things about Southeast Asia.
Okay. Peter, we never got to your poem.
Yes.
Do you have a poem for us
Oh,
this
yeah.
week?
I do. Of course I do, Maria. So last week, so what I thought, last week I did a haiku, Japanese poetry. Who doesn't like a good haiku? This week I thought I'd lighten it up a little bit with a limerick from Ireland. And here we go. There once was a startup so sweet, called chocolate, smooth in its beat. But miles were a glitch. Folks gamed them too rich. Now their savings account faced some heat. A promo too clever, too bold, turned miles into digital gold. When they pulled back the scheme, folks ran with a scream, their trust melting faster than told.
Well done.
Well played.
Beautiful. Beautiful.
There we go.
It's amazing that you take the time to write these instead of just outsourcing it to Manus AI or ChatGPT.
Would you know?
I don't know. That had a ring of Peter to it, in my opinion.
Did you tell Matt?
I've been training AI poet Peter for years.
Your inference use is amazing. Okay, folks, that is it for today. Thank you for tuning in. You can give us your feedback or nominate additional topics at 6040podcast@techinasia.com, and we will catch you in 2 weeks' time. Thanks, everyone.